Welcome to the Opening Bell Report.
Today, we have our sights set on a microcap energy company called Battalion Oil Corp.
Trading under the ticker BATL.
Right, BATL.
You know, when a stock chart looks like a hockey stick overnight,
Yeah.
the entire market starts asking the exact same question. Because an explosion in a microcap stock is, well, it's rarely random.
It's not a glitch.
No, almost never lucky accident. It's a puzzle waiting to be solved. And the financial data we are digging into today from our analysis report, it gives us the exact pieces to solve it.
Which is great because our mission for this deep dive is simple, but really crucial for anyone watching the energy sector right now.
Absolutely.
We are going to look under the hood of Battalion Oil to figure out exactly why they just surged 33% in a single trading session.
We need to know the why.
Right. We need to find out if this is just a temporary speculative pump.
Something is going to fizzle out by next week.
Exactly.
So.
Or if we are witnessing the very beginning of a massive structural comeback for a company that, honestly, everyone else had completely written off.
Yeah.
Okay, let's unpack this. The analysis report gives us the exact numbers. The gapped up surged 33.01%.
Closing at $5.52.
With an intraday peak of a solid $6.
Which is incredible.
Yeah.
But to really grasp the magnitude of what just happened here, we have to start by painting the before picture.
To dark days.
The very dark days.
Yeah.
Before this massive move, Battalion Oil was microcap that the broader market had essentially priced for insolvency.
Priced for insolvency. Man, that is just the market's way of saying they believe the equity is going straight to zero.
Straight to the floor.
I saw in the background financials that they were dealing with just a suffocating amount of debt. But, I mean, how bad was the actual operational picture?
It was a classic corporate debt spiral.
A spiral.
Yeah, because when a microcap company carries that much high-interest debt, every single dollar of free cash flow they manage to scrape together
Just vanishes.
It gets immediately swallowed by debt servicing. That's it. Which leaves absolutely zero capital expenditure or CapEx to actually grow the business.
Right.
You can't drill new wells. You can't fix broken infrastructure.
You aren't operating a company at that point. You're just working for your creditors.
Exactly.
It's like trying to tread water in the middle of the ocean, but somebody just keeps handing you 10-pound weights.
That's a perfect analogy. You're just waiting to sink. You have Kuiper paralysis.
Yeah.
You can't maneuver. You can't innovate.
You are just frozen, waiting for the clock to run out.
And that is exactly why this recent price action is so critical to analyze, because the data in the analysis report makes it explicitly clear that this 33% gap up wasn't a fluke.
It wasn't just retail traders pumping a message board.
No, it was the direct result of a calculated turnaround strategy finally snapping into place. Management actually executed on 3 very specific, massive catalysts.
Okay, here's where it gets really interesting. Because the source material outlines exactly how they stopped the bleeding. So let's talk about the lifeline first.
Catalyst number 1.
Right. I noticed they initiated a major asset sale to buy themselves some time. Walk me through that. How much of a lifeline was this?
It was the vital, non-negotiable first step to simple survival. So in February of 2026, Battalion Oil offloaded its West Quito assets.
Okay.
The final price tag on that sale was exactly $60.1 million.
$60 million.
Yeah. And that specific injection of desperate liquidity changed the entire math of the company.
But hold on, I gotta ask. Selling off assets to survive, that sounds a bit like, selling your living room furniture to pay your mortgage.
It does sound like that.
If you're an energy company, isn't selling an oil field just shrinking your future revenue? Like, how is that a win for the stock?
That is a very common reaction, and it makes sense. But you have to look at capital allocation.
Okay.
In a distressed situation like this, not all assets are created equal. You have your core assets,
The good stuff.
right, the highly efficient, profitable ones, and then you have your non-core assets, which might be too expensive to operate, or maybe they're just too far from your main infrastructure.
So they trim the fat.
Exactly.
Yeah.
By selling the West Quito assets, they shed non-core property to save the core business. And honestly, it's more about what they did with that cash.
Right, they didn't just sit on it. The filings show they immediately took a huge chunk of that fresh capital and threw it directly at their balance sheet.
$40 million of it, to be exact.
Wow.
2/3 of their lifeline went straight to aggressively paying down their high-interest debt. This is catalyst number 2.
Okay, if we connect this to the bigger picture, paying down debt sounds like, standard corporate housekeeping.
Sure.
But in this specific scenario, it was literally a matter of life and death because of what the analysis report calls frictional costs.
Oh, frictional costs.
Yeah.
They are the silent killers of microcap companies.
Break that down for us.
Well, when you're in distress, lenders punish you. They hit you with exorbitant interest rates. And that interest acts like a parasite.
Just feeding off the company.
Yes.
But
It constantly chews away at your margins, effectively wiping out your operating income before it even has a chance to reach the bottom line.
so it doesn't matter how well the oil fields are doing.
Exactly. You can pump all the oil in the world, but if your interest payments are higher than your profit margins, you are still bleeding out.
So by taking that $40 million and attacking the principal debt directly, management directly reduced those frictional costs.
They went right for the parasite.
They had to.
It was the absolute only way to save the company from eating itself alive.
Yeah.
But, and this is a biggie, but fixing the balance sheet only solves half the problem.
Right, because you still have to run an oil company. Which brings us to the third major catalyst.
The physical business.
You can have a pristine balance sheet, but if the physical oil isn't moving out of the ground and into the market, none of it matters.
Not one bit.
And the analysis report points out there was a massive clog in their operational plumbing. They were tied up in a really problematic gas treating agreement.
Right. So in the energy sector, getting the product out of the ground is only step one.
Okay.
You have to treat it, process it, and transport it.
Okay.
This is what we call the midstream process.
Midstream.
Yeah. And if your midstream agreements, the actual contracts governing that processing and transport, if they're broken, inefficient, or just overly restrictive, your entire operation backs up.
It just bottleneck.
A massive bottleneck. The wells literally have to be choked back because there is nowhere for the product to go.
Wow. So Battalion Oil made a drastic move here.
They did.
They terminated that problematic agreement entirely and completely shifted their operations over to a large cap midstream provider.
Which is huge.
But what did that actually do for their physical output? Like, what are the numbers?
The tangible result of that single operational change is staggering. By unclogging that midstream bottleneck, Battalion Oil added approximately 1,200 net barrels of oil per day to their production.
1,200 net barrels a day, just from fixing the plumbing.
Just from fixing the plumbing.
For a company of this size, that isn't just an incremental bump.
No.
That is transformative.
What's fascinating here is the cascading effect of that operational fix. It doesn't just bump up the daily production numbers. It actively de-risks Battalion Oil's entire 2026 revenue guidance.
Oh, because now they can actually rely on the flow.
Exactly. When a company proves it can consistently get that much extra product to market without the bottleneck, institutional investors can actually start trusting the future revenue projections.
It makes total sense. It's like, okay, imagine you have a massive factory that can produce 10,000 widgets a day.
Okay.
But the only road leading out of the factory is this tiny dirt path that can only handle one delivery truck at a time.
It's going to back up.
Right. It doesn't matter how great the factory is if the logistics are broken. Terminating that bad midstream contract was like paving a 4-lane highway right up to the loading dock.
I like that.
Suddenly, the revenue can actually flow.
And the broader market clearly saw that highway open up, which is the fundamental driver behind that massive 33% surge we saw.
Right.
But as we pivot from the excitement of the structural catalysts, we really have to ground ourselves in the cold, hard reality of the current financials.
Yeah, let's do that.
Because the underlying data in the analysis report tells a much more nuanced story.
We need a financial reality check. Because if you just look at the headline, a 33% jump, you might think this is some hyper-profitable tech stock. But looking at the traditional valuation metrics, the price to earnings, or PE ratio, is literally listed as NA, not applicable.
Yes.
Yeah.
Because despite the asset sale, despite paying down $40 million in debt, and despite clearing the operational bottleneck,
Yeah.
Battalion Oil is still fighting GAAP unprofitability.
GAAP, generally accepted accounting principles.
Exactly. When you look at their bottom line through that strict, standardized accounting lens, they still have negative earnings.
Negative earnings.
The financial data makes it very clear. If you are stepping into this stock right now, you are buying deeply discounted assets with turnaround potential.
You are not buying a mature, reliable earner.
Definitely not.
Which perfectly explains the massive discrepancy in their valuation compared to their peers. I noticed their price-to-sales ratio is incredibly low.
Very low.
Can you break down the exact multiple they're trading at versus the rest of the energy sector?
Sure. Their price-to-sales ratio is currently sitting at a mere 0.4x.
0.4.
Yeah. And to put that in perspective for you, the broader sector average is around 1.4x.
Wow.
So they are trading at a massive fraction of what their peers command based on top-line sales.
But why is the discount still so steep if they've supposedly fixed all these major existential threats?
Because the market has a very long memory.
Oh, right.
That 0.4x multiple is essentially the ghost of their past haunting their present. Even with these three major catalysts executed perfectly, The market is still cautiously pricing in the company's historical risk.
Investors remember the brink of insolvency.
They remember the crippling debt.
Yeah.
So they're demanding a massive risk premium, a huge discount to hold the stock, just in case the operational turnaround stumbles.
Just in case. But there is a major bright spot in the financials that proves the turnaround is actually gaining traction, right? The cash flow.
Yes.
We know JAP earnings are negative, but cash flow tells us what is actually going in and out of the bank accounts on a daily basis.
And this is arguably the most important metric in the entire analysis report.
Lay it on us.
Battalion Oil went from actively burning through cash just to keep the lights on to generating approximately $28 million in operating cash flow over the last 12 months.
$28 million.
Yeah. Their cash flow is now sitting at roughly 15.3% of sales.
$28 million in positive operating cash flow. That is the ultimate proof of concept for the turnaround strategy, isn't it?
Oh, absolutely. Going from burning cash to generating positive operating cash flow is the hardest pivot any distressed company can make.
Period.
It proves that the underlying business model, once you finally strip away the massive debt burden and the operational bottlenecks, it actually works.
Now, to give you some context on where Battalion Oil sits in the broader food chain, our source material contrasts them with a heavyweight competitor in the space, Antero Resources, ticker AR.
That comparison is incredibly useful.
Why is that?
Because it shows you the ceiling and the floor of the industry. Antero Resources is a dominant, mature player. Because they have massive scale, they operate with incredible 35% to 45% cash flow margins.
Wow, compared to 15.
Right. They don't have frictional costs eating them alive. Battalion Oil, on the other hand, is a high-risk microcap that just managed to stop the bleeding and hit that 15% margin.
So, synthesizing all these financial realities, the negative GAAP earnings, the deeply discounted price to sales, and the improving but comparatively low cash flow margins, what is the real takeaway here?
The real takeaway is that this 33% surge isn't the market suddenly declaring Battalion Oil a dominant Tier 1 player.
It's not a victory lap.
No, it is simply the market repricing the company from distressed and dying to viable and surviving. The bankruptcy discount is shrinking, but the risk hasn't entirely disappeared.
So what does this all mean for the actual mechanics of the market? How do these fundamental corporate shifts translate to the stock chart you see on your screen?
Well, fundamentals tell you what a company's inherently worth, but technical analysis tells you when the broader market is finally waking up to that value.
Right.
And the technical setup surrounding this surge is incredibly revealing.
The breakout itself was textbook. Looking at the market action in the report, the stock cleanly breached a heavy psychological resistance level at $5.
Scary clean.
And it didn't just drift over that line, it smashed through it on massive volume.
The term massive volume is the key indicator there. You know, when retail traders are buying a few hundred shares, the volume bars barely twitch.
Right.
But when a stock surges 33% and violently breaks a psychological barrier like $5 on massive volume, that is a glaring footprint.
It signals institutional or activist accumulation.
Exactly. The big money is stepping in.
And the data gives us a specific name to back that up. Diveroli Investment Group recently took a 5.39% stake in the company.
Which is huge.
That isn't a day trade. That is serious institutional backing, taking a significant ownership position.
And this raises an important question for you to consider as you watch this play out. What does activist institutional backing actually mean for the volatility of a microcap stock?
It's a double-edged sword, right?
Very much so. On one hand, an institution like Diveroli brings intense credibility. They have deep pockets, and activist investors typically don't just sit on the sidelines.
They get involved.
They often push for board seats, force strategic reviews, and hold management accountable.
Which can create a very strong floor for the stock price.
Right. But there is always a flip side when whales enter a small pond.
Yeah, microcaps are inherently thinly traded compared to large caps like Antero. There just aren't as many shares floating around.
Exactly. When massive institutions start throwing their weight around, fighting for shares, or reacting aggressively to earnings reports, the volatility can be violent in both directions.
It becomes a high-stakes tug of war.
It really does.
Well, for those of you watching the tape and tracking the chart, the analysis report gives us exact technical levels to keep an eye on.
Key levels.
Right now, the immediate floor, the support level, is what traders call the gap fill area. And that is right around $4.40.
And just to clarify that mechanic for a second, when the stock gapped up 33% at the open, it left a literal empty space on the daily chart.
Where the price just skipped over the lower levels overnight?
Exactly. So if the stock pulls back and loses momentum, traders will be watching that gap fill level at 440. Usually, buyers step in there to defend the new price floor.
Because they believe the turnaround is real.
Right.
But if this momentum holds and the institutional buying continues, The next major overhead target, the resistance level they have to fight through, is the 52-week high.
Which sits at $6.89.
$6.89. So those two levels represent the battleground for the coming weeks.
The gap fill at $4.40 represents the market asking, wait, was this surge a mistake?
Mm-hmm.
While the target at $6.89 represents the market confidently declaring the turnaround is structurally sound.
Bringing this all together, what is the final verdict on Battalion oil? The overarching thesis from the analysis report is very clear. This is no longer a passive holding. You just leave in your portfolio and hope for the best.
No, it is a highly active restructuring play.
Management is doing exactly what they promised the market they would do. They sold the non-core assets to get cash.
They paid down the crippling high-interest debt to kill the frictional costs.
And they fixed the midstream pipelines to get the oil flowing again.
And the massive 33% surge we saw is entirely justified by these fundamental shifts. The company fundamentally changed its trajectory and its survival odds in a matter of months.
However,
there's always a however.
There is a very careful caveat we need to echo from the financial analysis here, the reality check. The work isn't done.
Far from it. While the surge is justified, Battalion oil remains a highly volatile, highly speculative hold.
Still speculative.
Yes, the market has priced in the expectation of success based on these three catalysts. But the true test is just around the corner.
The earnings report.
The stock will remain speculative until these newly promised production rates, that extra 1,200 barrels a day from the pipeline fix, until that proves to be consistent and reliable in the upcoming Q1 earnings report.
They've talked the talk, they've cleared the way, but now they actually have to walk the walk, quarter after quarter.
The upcoming earnings report will be the ultimate judge of whether the parasite is truly gone or if it was just temporarily sedated by the asset sale.
Management has to prove they can operate profitably in this new de-risked environment.
They do.
It is an incredible story of corporate survival, though, just watching a company pull itself back from the absolute brink.
It's fascinating.
But I want to leave you with a final provocative thought to mull over, something that builds right on top of everything we just analyzed today.
Okay.
Think about the broader energy landscape. If a heavily distressed microcap like Battalion Oil can successfully clear its debts,
right,
if they can completely fix their operational plumbing and prove they can generate positive cash flow,
which they are doing,
and if they are still trading at a massive 0.4 price-to-sales discount compared to the rest of the sector, does this make them the perfect, newly viable acquisition target?
Oh, that's a great question.
Are massive cash-rich energy giants out there like the Antero Resources of the world looking at Battalion Oil right now, just waiting to swallow up these cheap, newly de-risked assets without having to deal with the messy turnaround themselves?
You know, it is the logical and often highly lucrative next step in the life cycle of a successful microcap turnaround.
Right.
Once you prove you can survive and you clean up your balance sheet, you suddenly become very, very attractive to the big fish.
They just want your physical assets without the corporate headache you just cured.
Exactly. It is absolutely a dynamic to watch closely as this unfolds.
It is going to be fascinating to see how this plays out over the next few quarters. Thank you so much for joining us on this deep dive. We love peeling back the layers on these massive market moves to find out what is really going on beneath the surface. Stay curious out there, keep questioning the obvious, and keep exploring the fascinating mechanics of the market. We'll catch you on the next one.
Don't forget to like, share, and subscribe for more.